Hey, everybody. We're so excited to have Bernard Reisz on the Tech Guys Who Invest podcast. Bernard, welcome to the show.
Kevin, Adam, thanks so much for having me. I've been looking forward to this. And I got to say something unique. I often get asked, why do you have the Golden Gate Bridge in the background? And there are a couple of good reasons. I use it all the time. But now that we're with Tech Guys so close to Silicon Valley, I actually feel really at home with the Golden Gate Bridge.
Nice.
Awesome. Well, that's fantastic. Yeah. Now, the first question we want to ask you is, what is a checkbook 401k?
Okay. Let's dive in. A couple of moving parts here. So when we say 401k, that's a term that everybody is familiar with, just about everybody. You've got a job, it probably came with a 401k.
Right.
So a 401k is a 401k, got lots of complex rules. But what tends to happen is that the plan and the company are allowed to be a lot more restrictive than the tax code are. And the way these plans are set up, it's been a bit of a slush fund for financial institutions. The employees put the money in, and that pays all sorts of fees. They're set up generally so that it costs the company as little as possible. But then there's this pot of money to pay all the different people that are servicing the plan, and you get all sorts of restrictions. So when we say checkbook 401k, we're taking the 401k and returning it to what it really is, a pure 401k, where you get direct access to your money and you can invest it in anything that the tax code allows.
Nice. Yeah. That's interesting. You said a few things in there we definitely love to unpack. One of the things Kevin and I like to do is educate people on financial concepts, help them increase their financial intelligence. And when we can talk about things that not that many people know about or are able to kind of find out about on their own, we think it adds a lot of value to them. And fees in 401ks is one of those things. I just don't think many people understand. Heck, I don't understand how many fees there are in my 401k, right? Like, can you talk a little bit about that and maybe help some of our listeners who are W-2 employees who have been putting money in 401k, how many fees there could be in a 401k?
Yeah, let's do this. It's kind of dizzying and it's almost impossible to get to the bottom of it. Right. Financial institutions do a great job of hiding things in the fine print. The regulators come in and then they say, okay, you have to be more transparent. So they'll kind of make sure to meet the letter of the law, but not the spirit. And then again, you're left scratching your head and trying to figure out what all the fees are. So who are the providers? Who are the service providers to a plan? And what do you need to run a full-blown plan? So there is a plan document. That's one component of the service, right? A 401k plan, when it's created, is essentially a trust that has lots of complex verbiage based on tax law and labor law. So the law governing qualified retirement plans, of which 401k is one type, is one of the most dense and abstruse areas of law, and it's got the overlap between tax and labor law. So the first thing is getting the plan document. And there are a lot of decisions that companies have to make when it comes to designing the document. But that's one service provider and one service, which is getting the document. And before we talk about the fees for a moment, right, the plan document, that's where the company is going to say, okay, we're not letting you do this. We are letting you do that. We're going to limit your investments. We're going to limit your control. We're going to limit when you can take money out, when you can put money in. That's the point at which all those decisions are made when they design the plan. Now, once the plan is set up, it's usually set up in conjunction with a financial institution, financial advisor. So that person is usually the one that's in charge of setting up the menu. Does that mean anything to you, the menu? Do you recognize that term? You get your menu.
Is that the funds you can pick from?
Exactly. That's your menu of funds. So the financial advisor kind of sets up the menu. And there are some laws about what they have to provide you with. But once that menu's set up, it's kind of static. And the financial advisor is getting generally a percentage of all the assets in the plan because he set up the menu, and maybe once a year he's going to go revisit that and say, all right, let's take out this mutual fund and swap out that one. He's getting a percentage of that. Now, on top of that, you're also going to have each mutual fund has fees built into it. So the financial advisor is getting a percentage of the assets because he said you can pick these 30 mutual funds. But each mutual fund has its own expense load, which is almost impossible to decipher. So you got to dig down to the asset level and figure out all the fees that are in there. So then there's the management fee. There could be 12B1 fees. There can be commissions. 12B1 fees are fees that get kicked back to other financial institutions. So far we've got the document provider, we've got the financial advisor, we've got the actual fund expenses. Now you've got a custodian who's the one that holds the assets, right? The custodian also gets paid. So that's another layer of fees. Then let's add the record keeper. Now, what's the role of a record keeper? The record keeper is one that keeps track of, all right, John Doe contributed $5,000. Jane Doe invested in, John Smith took a distribution. The record keeper tracks all that. The record keeper's got to get paid. Now, then on top of that, you've got what's called the TPA, the third-party administrator. And the third-party administrator's role is to ensure that the plan actually runs compliantly, and it runs in accordance with the plan document that was set up, and that all these contributions that the record keeper is tracking is actually not running afoul of labor and tax law. So the TPA gets paid. So where are we at? We've got TPA, record keeper, custodian, mutual fund managers, financial advisor, document provider. Do we need any more?
I don't I would think so. I'm like blown away. Yeah.
So as you're describing this, I was thinking, what are the fees that the 401k my company has? And one of the funds that I had money in a 401k with, the expense ratio is 0.15%. How would you translate that into layman's terms to kind of bring home the fact that there's so many fees in a 401k?
Yeah, because that sounds low, right? If you say
that absolutely is. And let's put that in perspective. You only have getting 0.15 as an expense ratio on a mutual fund is actually quite low, right? But it's been about a 70-year journey to reach that point at which companies are providing this, right? So let's understand there are a lot of different incentives here that are totally perverted, and it's been a very long battle, and only in the last 10 years has the tide began to turn. So there are two things that the company has to think about. One is who's paying for all these fees, right? It's supposed to be an employee benefit that the company pays for. But what usually happens is that, no, the fees come out of the plan money. Well, whose money is in the plan? It's the employee's money that's in the plan, right? And then there's, okay, what are we going to choose? Are we going to try to choose things that are in the best interest of the employees? Or are we just going to, this is going to be, all right, the financial advisor, I don't know, I like him, he's my buddy. All right, I'll give him the business, right? It's kind of more or less they're all fungible, right? They're just selling mutual funds. So it's just like, all right, I like you, or you're my neighbor's kid or whatever. All right, you get 2%. And then he's thinking about, all right, he makes more money by putting in this mutual fund. So he puts that in. And then you can have a 401k plan that is just plagued with fees. You don't stand a chance of making money. And if you just go Google 401k lawsuits, you'll see what has been going on. But this is even a battle within Wall Street that's going back 100 years, which is all the fees that people pay and the conflicts of interest that are inherent. So to get to used to be fees, on a mutual fund, expense ratios, you were looking at 1% to 2% at a minimum. It's only in the last 5 to 10 years that we've gotten mutual funds with an expense ratio of 0.15. So 0.15 is actually quite low as an expense ratio. Now, at the same time, to put that in perspective, you've got to think that for every dollar that you've got in there, you're paying a percentage of that to somebody, right? And then if you stack all these different fees on top, you're looking at 3 to 4% of your money is getting paid. Well, how much do you actually make in the market?
On
Right?
average, they say 7%, 7 to
Okay.
10.
So let's say, all right. So when people say, oh, 4%, that's not a lot, right? Because 4% of 100% doesn't sound like a whole lot.
Right.
But when you realize that that 4% represents 50% of your profit,
Wow.
right? That's another way of looking at it. You give it away and think about the opportunity cost, the compounding over 50 years of paying all those fees, right? It's the opportunity cost. It's like, hey, if I would have had keep all my profit every year, then I can turn this. That's worth millions of dollars over a lifetime. And I'm not exaggerating.
Yeah.
Put that in a spreadsheet. That is millions of dollars over a lifetime in foregone compounded returns. So that's and ironically, sometimes people come to us, and what our focus is actually putting you in control. So there is no custodian. There is none of these fees go away. You don't sell mutual funds. It's like, hey, you get the money in a bank account or in a brokerage account that you directly control, or both. You can have all of them. So you're not paying all these fees, and someone's like, oh, but why am I paying? Why am you paying anything? My 401k was free till now. And I'm like, 1 second. If you move $500,000 into an account that we set up for you, and let's calculate what you were paying in that $500,000, you just saved 20 grand just by all those hidden fees going away. So the cost of having a 401k that is loaded with fees that you can't see, it really has an incredible negative impact on your net wealth. And you can't look at it on a year by year basis. You've got to look at it over time. All right, yeah, 1% this year, not so much. But what about the compounding of that? It is absolutely huge.
Okay, so if someone does move the money into an account you set up with them, they can buy things other than just stocks and ETFs and bonds and things like that, right?
Oh, yeah, absolutely. And I like to emphasize, I'm not against ETFs and stocks and bonds, but I am against having people blinded. And the tragedy of it is that people don't know, right? If you know that I don't know, somebody's got you shackled, all right, you can try to figure out how to get out. But the painful part of this is that most people don't even realize, right? They're so blinded that they don't know that they're blinded, so that you don't have a prayer. So yes, you can, of course, do ETFs, and that's cool. Choose that. That's for you. Do it. But many people, were they to be exposed and know about the other opportunities, that's what they would embrace. And we want people to know that you can do that. If you want to invest in real estate, cryptocurrency, tax liens, you want to do hard money loans, notes, any of these stuff, precious metals, you can do that. The tax code in itself has almost no limitations. When I ask people, like, what do you think the tax code says about what IRAs, 401ks, and QRPs can be invested in? And like, does the tax code say you can invest? What would you say? Does the tax code say that you can invest in real estate using a QRP or 401k? What would you say, Kevin?
Yes, you can.
So the answer is yes, you can, but the tax code doesn't say you can invest in real estate. But guess what else the tax code doesn't say? It doesn't say you can invest in mutual funds. It more or less is silent, right? It says, hey, put money in here and you'll get tax benefits. Use this type of account and you'll get tax benefits, and you can invest it. You don't have to pay taxes on that. It doesn't say anything about investing. It just says more or less no collectibles. That's the extent of it. Don't buy rugs. Don't buy antiques. Don't buy fine wines and art. There are a lot of rules governing, I guess, precious metals, and some rules regarding life insurance, but it doesn't say anything about what you can invest in. It just has like a very, very short list of what you can't invest in. Everything else is equal in the eyes of the tax code, and ETF and real estate are just as legal.
Interesting. Well, thank you for sharing that. And one thing that we want to understand, and I'm sure our listeners do too, if they're listening to this and they say, wow, I feel like I should have a checkbook 401k, how do you know if you qualify for it?
Okay, that's a very, very loaded question. So there are many different types of retirement accounts that the tax code creates. And every single one has its place based on the investor's tax profile. Very broadly speaking, there are two groups of plans. There are qualified retirement plans, which industry professionals were just referred to as shorthand as qualified plans or QRPs. That's one group of plans. Then there's another group of plans that we all know as IRAs. IRA stands for Individual Retirement Arrangement. Within each of these, there are multiple types of plans. So some plans need to be connected to a business and some be connected to an individual. Are you guys okay going into the weeds?
Yeah, I think it's important that we go into the weeds. You're talking about a business versus an individual. And I guess to expand upon where I'm coming from, if you are a W-2 employee and you're learning about 401ks and you're like, wow, I basically have no control with my money, but the 401k is provided for your employer and they want to transition to investing in real estate, would they still be able to do so having being provided a W-2 401k type of thing? That's where I'm coming from with that.
Okay, so you can have and participate in multiple 401ks. So that in and of itself is all cool. And actually, if you really understand how the taxes work, to a certain extent, you can double up. So you can actually have greater contributions, greater tax deductions, or more Roth money. So if you value Roth money, you into Roth? Who likes Roth?
I like Roth.
I like Roth.
Okay, right. If you want to create $60,000 of Roth, right? With our plans, the way we set them up, you can do that. With your employer plan, it's not that nobody knows how to do it, but they're just not going to give you that. It makes it too complex for them, and they don't want to. Right? They're looking to keep it as simple as possible. So you can double up on some of these things if you have a plan with your employer and a plan with us. But what we're going to be looking to figure out when we work with somebody is we'll be setting them up with some type of qualified retirement plan or some type of IRA. So qualified retirement plans include 401k plans, defined benefit plans, cash balance plans. So QRP is just kind of a term that includes a whole group of plans that are governed by labor law. And then IRA is a group of account types that fall into a different section of the tax code. So some of these need to be tied to a business. So if you work for somebody else's business, W-2, you can still have your own business. And then you can use the type of plans that a business can have. And if you don't have your own business, you may be able to create one, or you may be able to, use a type of account that doesn't require the business. So what type of plan any individual is going to work for is kind of on a, requires analysis on a case-by-case basis. I cannot say enough. There is no one size fits all. If anybody is telling you that this is the plan that everybody should have, there's a conflict of interest there. And so it's really case by case. And you can have the 401k your employer, and you can have another 401k provided you meet the guidelines, which we discuss with our clients, for them to have their own 401k.
Bernard, can you talk to us a little bit about the biggest tax pitfalls you see people make?
Okay, there are so many different areas, and I guess we'll focus on retirement accounts.
Yeah, right. Focused around retirement accounts, investing in, perhaps investing in real estate through retirement accounts, anything in that area.
Yes. So the one fundamental mistake is when people make in decisions that are not well educated. So the premise that I've got is every decision can be a correct decision so long as it was made intelligently and with the full deck of information. So there's very few things that are a bad decision, but there are great decisions and poor decisions if you didn't make it wisely, right? So you can get into an investment understanding the risk return. If it turns out that you get that incredible IRR, amazing, right? And if you end up losing some money on the deal, that's not amazing, but it doesn't mean it was a bad choice. If at the time you went into the deal, you said, all right, this is the upside, this is the downside, these are the risk factors. We're going to try to mitigate those, and we're going to go into the deal, but we don't have a crystal ball. So the fundamental thing that underlies most of the mistakes and pitfalls that I see is people that are not getting information from good sources. They're kind of getting sold on something and not getting honest information. So they're getting either incomplete information or something half truths, and they're not getting something tailored to them, giving them all the information. So that being said, what are some examples? So the first place where you get a mistake with retirement accounts such as these is if you get the wrong type set up, right? So the wrong type can be the wrong type because from the tax code perspective, you can't have that one, right? You can't have that account type. And if you have it, even if you got all the right paperwork, it's not a qualified retirement plan because it's not set up the way a qualified retirement plan has to be. It's that jigsaw puzzle is not in place. Right. So they're kind of from the get-go, you can be gone. Then, right, and so somebody rolls over money to that plan, which is not really a qualified retirement plan, right? They may have the piece of paper that says a qualified retirement plan, but it isn't. So you got to get the right type of retirement account as opposed to like the wrong one. Then at the rollover level, and these are all mistakes that I have seen by people that are well-meaning, but that have unfortunately kind of bought into plans, somebody that's just out there selling these things and promoting it, is what kind of money can you roll over? You can't, not all account money, retirement account money can be rolled over between retirement accounts. So it's not like, oh, I've got this retirement account, I can roll over to here. There are some, good rules of thumb, and then sometimes it gets really complex, what kind of rollovers you can do. But the big one that I've seen is people rolling over Roth IRAs to a qualified retirement plan. That's a no-no. And I've actually even seen, it's no longer there. It's since been taken down. But on a provider's website, yes, roll over your Roth IRA to your Roth qualified retirement plan. I'm like, no, you can't do that. But that's right there. That's a taxable event whenever, if and when it gets picked up. Then the other set of mistakes happened. That's kind of the mistakes that relate to people that get qualified retirement plans that they should not be having. Mm-hmm. But the mistake goes the other way. A lot of people have self-directed IRAs that would be better served by having some sort of qualified retirement plan. And the qualified retirement plan does have some downsides to it, some sort of drawbacks to it. And so if the first thing is the level of complexity associated with it is just so much greater than that of an IRA. And what I always try to tell people is make things as simple as possible, but no simpler. And that's not my wisdom. That's Albert Einstein. So, right, when you oversimplify, you're going to end up with mistakes. So for people that can be well served by something that's simpler, maybe it's using kind of in a way Occam's razor. Familiar with that?
I've heard of it. Yeah.
But that's like whenever you're trying to design something or find an answer or a solution, you should be biased towards the simplest solution. That's probably going to be the closest thing to the truth. So not everybody. So having a qualified retirement plan has additional complexity, which if you don't benefit from all the pros of a 401k or QRP, why get it? You're just getting additional complexity and additional potential for getting tripped up that you can do without.
Right.
However, one area where it really can make a difference is with regard to UDFI. Are you guys familiar with UDFI?
Yes. But
for listeners who aren't familiar with it, can you kind of just briefly explain what it is?
Absolutely. People are maybe surprised to learn that even entities that you think don't pay any tax, like United Way, all sorts of charities, pay taxes sometimes. Certain things that they do make them pay taxes. So even though they're tax-free entities, certain times they have to pay taxes. Same is true for a retirement account, which is a tax-free entity. So there are a lot of taxes that UBIT taxes that IRAs and QRPs can be subject to. And yes, I do encounter lots of people telling me that QRPs don't have UBIT. QRPs absolutely have UBIT, but there are some narrow exceptions that are important if you invest in real estate. So a subset of UBIT is something called UDFI, unrelated debt financed income. And let's try to examine how that works. Say you've got 100 grand in your retirement account, right? Or United Way has $100,000. It's not a retirement account, 501c3 tax-free entity that it wants to invest in real estate. Well, it's got a choice. It can go buy a piece of real estate for $100,000, or it can buy a $300,000 asset, putting down 100 and getting the bank to put up the other 200. Which one would you do?
Well, I personally would do the latter.
Okay, absolutely. That's the great power of real estate, right? It's the most secure asset out there. Banks love lending against real estate. They feel great, right? The value's here, and it's not going anywhere. You can't put it in your pocket. You can't put it in a Swiss bank account. There's nothing you can do with that real estate. We'd love to lend you money against your real estate. So why? All right, you got to pay some interest, right? But your gain, your return on the leverage portion is just, obviously if it goes against you, leverage is not a good thing. But assuming you've got a good deal on your hands, this leverage is incredible. You'll pay some more interest, which actually offsets your taxes if you have any taxable income. But you're going to get a return on a $300,000 asset, which is so much higher. All right, no brainer. You go for the leverage.
Right.
Now, say you do this in a taxable account. You do this in your own name. You have the potential to pay taxes on the deal.
Right.
Now we know in real estate, you're not going to have taxes, right? Because with all the non-cash write-offs, depreciation, and you can potentially get accelerated depreciation and bonus depreciation, you're not seeing any taxable income. You may be cash flowing, but no taxable income. I'm assuming this is stuff that you guys have spoken about a lot on this podcast.
This is one of the reasons we love real estate.
Yeah, conceptually, but we're not CPAs, so we don't try to speak as if we are. We may parrot what you say, but we're not going to try and teach tax in that regard. So in a way we do, but in a way we don't also.
Okay, I get that disclaimer. Yeah, you got to put that out there. So you're probably not going to have a net taxable income. But at some point down the line, you're holding onto the property a couple of years. Now, all of a sudden, you raised rents, right? Your interest payments are flat, right? Those stay flat. You got your fixed, maybe you've refied. And now, all of a sudden, you're 5 years into the deal, and maybe you're showing net taxable income, right? And so that's all taxable income, unless, of course, we use other tax tools to eliminate that. But let's just keep it this deal on itself. It's generating net taxable income. Now, suppose you've done this deal inside of a retirement account, and your retirement account has 1/3 of the equity, right? And 2/3, there's debt, right? So you put in 100, the bank put in 2/3. Well, a retirement account is tax-free. So should all this money be tax-free, or is only the equity portion tax-free?
I would hope everything's tax-free.
Right, and that's the way it was up until the late 1950s. And then being that some couple of different things that were going on, and tax-free entities, charitable entities, well, retirement accounts at that point, were kind of abusing their tax sheltered status. Congress came in and said, the portion that's leveraged is taxable. So your 100 grand that you had in your retirement account, the return on that stays tax-free. But the return on the bank's money is taxable. And that's what we call unrelated debt financed income, which is taxable to charitable entities, taxable to retirement accounts, with the very cool carve out, which is that qualified retirement plans do not have this tax on real estate acquisition indebtedness. So it's a narrow carve out for qualified retirement plans with regard to real estate. So this is where, if you're a real estate investor, there's a fundamental difference between a qualified retirement plan, such as a 401k, and an IRA-based account. So that's a very, very key difference. And depending on what you're trying to do, and depending what you're planning to invest in, you may be better served by some sort of qualified retirement plan. That being said, of course, if your money is in a Roth IRA, you cannot be well served by a qualified retirement plan, because the moment you try to do that rollover, you just made all that money taxable. Or if you don't qualify for having a QRP because of your tax profile, it's not the best idea, right? The best idea is still going to be, all right, do it in an IRA, deal with the tax. But the question that you want to ask yourself at that point is, is not that, like, I wish I could have a QRP. The question you want to ask yourself is, okay, is it worth restructuring myself to qualify for that? What are the rules? Can I qualify? There's a lot of court rulings about, that provide a lot of indication of what does and what doesn't qualify. But it's the question that sometimes, the people that clearly don't fall, say somebody can't have a 401k, or any other type of QRP. The UDFI should not intimidate them. Now, what the mistake happens, where's the pitfall? The pitfall is when somebody sets up an IRA and nobody tells them that you're going to have UDFI. That's where there's a pitfall.
Yep,
right?
I agree.
But if somebody, and the same pitfall you got if somebody sets up a QRP and nobody told them, hey, maybe you don't qualify for this, right? That's perhaps an even greater pitfall. So the pitfall doesn't lie in making it's making that uninformed decision. So if somebody is looking, let's say they're having an IRA, they may say, all right, maybe we're going to have this UDFI, so I shouldn't invest in real estate. They should not be intimidated by that, because what you're really looking at is, if you're looking to get into real estate with your IRA, that means you've got some pretty good reasons why you want to move from the stock market into real estate, right? Either you're looking at higher ROI, you're looking at diversification, you're looking to get rid of some volatility, you're looking for something more stable, you're looking for cash flow. There are a lot of things that real estate offers that stocks don't. And again, I always say they're not mutually exclusive. Be diversified. That's cool, right? I'm just against people that are all in stocks because nobody opened their eyes, right? So, and then it's like, all right, so even after contending with this potential tax, you'll still probably come out way ahead doing the real estate. Okay, it's nice. You thought you were going to do this real estate completely tax-free. All right, there's going to be some sort of tax on the bank's money. Right, all right, it's a similar mistake. People are like, okay, so then I want us to get rid of UDFI, so I'm just going to do an all-cash deal. I'm going to buy the $100,000 asset instead of the $300,000 asset. That's not smart.
Yeah,
right?
I agree.
Yeah.
Right. Just like, how about somebody tells you, I'm going to buy a $100,000 asset because if I buy the $300,000 asset, I have to pay the bank interest. Right? How does that sound?
Right. Yeah. You'll still net out better with the 300. So go with what the net better return is, right?
That's exactly it. I mean, Adam, you said that's the question people have to ask themselves, right? Not like, all right, how much does UDFI cost me?
Mm-hmm.
It's not important. Where is your net wealth going to be on this side? And where is your net wealth going to be on that side? And that's a decisive factor.
That's beautiful advice that I think our listeners really need to listen to again if you didn't get it, because not enough people say that. Experienced folks, they learn that, but until you get to a certain level, many people get fixated on that. Oh, I don't want it to cost me. They're still thinking in terms of that cost mindset, right?
Adam, I just had this conversation with a couple of clients today. and talking about the cost of certain deals they're going to do, the due diligence. And I'm saying, all right, you're not used to spending $20,000, but you've got to take a step back, realize, yes, you're in a different league now. You don't buy a $2 million asset every day, right? So if I ask you to spend $20,000 today, you're like, no, that's a lot of money. That's waste. This is not waste. This is part of your investment. And you've got to change, you got to reframe, and look at things differently. Don't let that trigger, wow, 20 grand. That's a lot of money. Don't let that trigger you. Again, make a smart decision. All right, if the numbers don't add up, if it doesn't make sense to do $20,000 of due diligence on the deal, then don't do it. But don't let the cost, just the emotional aspect of that, get to you.
Yeah, that's great advice on reframing. And that comes with the education. You start to look at things from a different lens when you enter in that, input that information from various sources, smarter people like yourself, or books or podcasts that you're reading or listening to. Very good point. I love that. And speaking of tax, you mentioned that before we kind of hit record, you wanted to talk about Biden's tax proposal. So we would love for you to tell us about that talking point.
Okay. This is timely because we're in a period of uncertainty here. Where are things going to go? Mm-hmm. But Biden has made it clear that he will be raising taxes, and he's targeting real estate investors specifically. So he's targeting everybody, but with a special focus on real estate investors. They've given us some very clear proposals, and some vague, items, things that we don't like, but they haven't told us exactly what they're going to do. So they have said that they want to eliminate 1031 exchanges. That's it. 1031 exchanges.
Wow.
Going away. Well, I'm not saying they're going away, but that's what they would like to do. That's something that's out there, that they said, very specifically they'd like to do. That's a big one. Number two, they want to raise capital gains rates to the same rates as ordinary income. So right now you hold a property, right, and you sell it, you got long-term capital gains rates, plus, you've got depreciation recapture. You can have net investment income tax, but at the base of it, you're paying capital gains rates, which range from long-term, which range from 0 to 20% when you sell an asset without a 1031 exchange, right? So here's the saying: we're taking away 1031 exchange, and we're going to raise the tax on that to 40%.
Ouch.
That is punishing. Another thing that they've said they don't like, but we don't know anything specific, they say, we don't like the fact that real estate investors are claiming depreciation deductions when they're really making money. They've said that. Now, what they might do with that, from a policy perspective, how they would change that, they haven't made anything clear about that. What they would do, maybe they'll get back one thing maybe they would eliminate is what's called the real estate professional status. Have you guys ever spoken about real estate professional status?
No.
No, I don't think so.
Okay. So what that means is, and this is great. It ties in very well with what we're talking about, the retirement accounts. Should you invest in real estate in your retirement accounts? Is that a good idea? All right, we know it's legal. We know we can do it. We know there's a right way to do it, a wrong way to do it, and the optimal way to do it. But maybe there are reasons that we shouldn't do it. And one thing that we see out there is people say is, I'm going to lose my real estate losses. I'm going to lose my losses. And for most people, that's really not true. Not that it's even should be a factor. Again, they're asking the wrong question, because the right question is always, okay, you've got $300,000 in your retirement account. Is that best invested in mutual funds or in real estate? Everything else is immaterial. Okay, if you owned it in your own name, would you get some deductions from it? Okay, if you invest your retirement account in mutual funds, you're still not getting real estate deductions on your tax return. So it's just a total red herring. It's the wrong question. Again, the question is, all right, you got money in the retirement account. How's that best deployed? But to go back to, that point, does it have validity to it? For most people, especially if you've got a W-2 job, if you have a real estate asset that has a loss, what you end up with is a suspended passive loss. You cannot use that loss to offset your W-2 income because that is a passive loss, and passive losses cannot offset active income. So if at your job you're making $200,000 and you have $200,000 of real estate losses, you're still paying taxes on 200 grand. Even though you've got 200 and they should net out, they don't net out. One's passive, one's active. They don't net out, and you're still paying taxes on 200 grand. So that is what's called the passive loss limitations. Congress got in. They said, hey, we don't want people investing in real estate just to create losses. And so they put that in there. The real estate industry got really upset. And they said, all right, we understand you don't want tech guys, sorry, and doctors to be kind of investing passively and using that just as a tax shelter. But say I'm a full-time real estate person. I'm a real estate agent. Real estate's my life, right? That's what I do. I should be able to use that kind of one big business and use losses for my rentals to offset my active income. And so if you meet the guidelines of real estate professional for tax purposes, it's got nothing to do with having a realtor, a real estate agent license. It's a tax concept. Then you can take those losses, those real estate losses from your multifamily or your duplex, and you can use it to offset the income that you've got that is active income. It's kind of all treated as active, and you can offset your W-2 theoretically. But most people that have a full-time W-2 cannot be real estate professionals for tax purposes.
Right.
So they're not getting the benefit. Those losses, they just kind of sit on the tax return. They're suspended, and they just roll over from year to year until you have passive income. So one thing I'm speculating Biden may want to do if he gets to office is say, we're getting rid of real estate professional. There was a period where it was a couple of months where there was no real estate professional concept. And maybe that's what they're going to do. They're going to say real estate professional status goes away. I'm thinking that's one thing that they might do. But the upshot of all this, if in fact any of this comes reality, this is enhancing the appeal of using retirement accounts for real estate. Because if and when the other benefits go away, qualified retirement plans and IRAs are kind of going to be the last frontier where you can still really do things tax-free, and you're not giving up anything on the personal side. So even if somebody is a full-time real estate investor, which up until now, I'd say for full-time real estate investors, retirement accounts have not been a focus unless they wanted to deliberately create Roth money, because Roth is tax-free, and that's the holy grail. And that's valuable to everybody. So we maybe see a change where qualified retirement plans and self-directed IRAs become the go-to tax tool for so many more people.
Wow. That's fascinating. Very interesting perspective there, Bernard. So we wouldn't be the tech guys who invest, Bernard, if we didn't ask you a tech question.
You didn't prep me for this. You didn't tell me,
We would love to know what one of your favorite pieces of tech is. Maybe it's something that makes your life easier professionally or personally, or maybe it's just something that you love. What's a piece of tech that kind of stands out to you?
All right. I can take the easy one and say Zoom, but I feel like you must have gotten so many Zooms over these. You should probably disqualify Zoom. Zoom's not an acceptable answer.
During the pandemic, Zoom doesn't count.
So the next tech tool, I think, would be CRM tools. And there's one in particular that I like called Visita. And it's, there are so many CRM tools out there. And if you want to have something that's hyper-focused on a certain things, then you're looking at a certain tool. But if you're looking for something that's multi-purpose, kind of Swiss Army knife, may not be the best at, if you're looking at if you're looking for email marketing and all that, it may not be the best. Maybe you want Active Campaign. Maybe for that thing, you may want Customer Hub and, again, what the Infusionsoft, what they used to call themselves, right?
Mm-hmm.
But if you want something that's versatile, I think that's an awesome tool.
The last question we want to ask you is, you talked about a lot of stuff, and Adam and I always advocate that you should have the right team members. How would somebody go about finding you if they wanted to add you on their team?
So what I tell people is, we can give them like URLs and email addresses. Obviously, we can say reassurefinancial.com, but something, just Google Bernard Reisz. You will find incredible amount of information, and it will lead to me. You can find me on LinkedIn. And so all this, Google Reassure LLC, Reassure Financial, Bernard Reisz. I've been pretty good about putting out info, and I do my utmost to make it substantive. So if you kind of find stuff out there and you're looking for information that's not salesy, it's not gimmicky, we're targeting your brain, not your emotions, you're going to find lots of good stuff.
Awesome. Well,
That's
thank you so much for your time, for all that knowledge, Bernard. We really appreciate this, and maybe we'll bring you back on if, pending what happens at the 2020 election, to talk more about the tax plans and how it affects people.
Yeah, be glad to. This is a cool topic, and now is the window of opportunity. I actually set up a poll on LinkedIn to try. Are you guys active on LinkedIn?
Yeah.
Oh, I can share this with you to try to get a feel for a couple of things. Feel for what's really going on with the election here, right? Can you trust the polls, not trust the polls? And what some people are saying is you can't trust the polls because you've got lots of hidden, closet Trump supporters. I don't know if that's true or that isn't true. The Trump supporters that I know are pretty vocal about it. And the ones that are anti-Trump are pretty vocal about it. At least the ones that I know. But you can tell a pollster whatever you like, but actions, you got to choose what you do. So with that's kind of the real indication of what the sentiment is. So I've put up this LinkedIn poll for investors. If you're a real estate investor, what are you doing now? Because if Biden is coming into office and you think we're going to have a Congress controlled by the Democrats, you may want to sell your property now and cash out, do your 1031 while you still can. But if you think we're going to have another 4 years of Trump, and that means, come November, real estate's getting a bump, then you hold on. So I'm trying to get a feel for what people are really doing and really feeling. And I'd love to share that with you and get you guys to vote on it.
Yeah, absolutely. Share it, and we'll put it in the show notes with the other information you spoke about so others can find it as well.
Okay, awesome.
Yeah.
Well, thank
Thanks,
you so
Bernard.
much.
Thanks for having me. I've loved this.